Welcome, everyone, and thank you so much for listening in. Today, we're going to talk about how bonds work. But before we do, as a reminder, this is an educational show and should not be construed as personal financial advice. Full disclosure information is available at ototnow.com. Now, let's get started. So, first of all, why talk about bonds at all? Because a lot of people don't have very much exposure to them. Well, we do have an election coming up in a little over 3 months. And if you're more actively involved in managing your portfolio, then you might consider going to increase your bond exposure, which is in turn decreasing your equity exposure. So if the market does take a huge roller coaster move through the election, if you reduce your equity exposure, that dampens that volatility out. Bonds tend to act opposite of the equity market. So if the equity market sells off into the election because of the uncertainty involved, then the bond market generally rises as money flows out of equities and into bonds. That's basic supply and demand. However, you're right, that did not happen back in March. Everything kind of sold off when COVID-19 hit us, and folks just wanted to be in cash. So they kind of sold everything. So that was the first time I have seen in my investing history since I was 16 years old. So that's a lot of years where both the bond and equity markets were hit at the same time. And I don't expect that to happen again, barring a situation where governments come in and force their economies to shut down. So that's not what we're talking about with the election. What we're talking about with the election is the increased volatility could cause a market sell-off. Again, no crystal ball. But when you look at the potential outcomes, there's scenarios in both cases that the equity market would sell off. So that's why I'm talking about bonds now. Many people just simply buy the Vanguard bond fund, and you can do that. However, if you want to, as with equities, be a little more surgical with your investing, and you want to be a little more efficient, i.e. you don't want to pay a fee for the bond fund to do it for you, you can actually go in and do it yourself. And that's what we're going to talk about in this podcast. So the first thing we want to talk about with bonds is the basics of the bond ladder. So if you've heard that term, just picture you own, say, maybe 5 different bonds, and they each have a 6-year maturity, and you buy all 5, and then after you wait a year, your bond that is maturing in, say, 2021 matures, and so when a bond matures, you get your money back, you get the last coupon payment, and then you roll that bond forward basically 5 years out to, quick math, 2026, and you buy another bond that matures in 2026. So your 5 bonds basically are laddered so one matures every year. And that way, if interest rates are low, which means bonds are paying less because they are tied to interest rates, not directly, indirectly. But if, in a low interest rate environment like right now, where investment grade bonds are only paying that 4%-ish, 3.5% sometimes, unless you can find a good deal. Well, if you just keep it the bond ladder, you have one, it's like dollar cost averaging in equities. You have a bond maturing every year, or you could have a whole bunch of bonds and they mature every quarter, however you want to set up your ladder. But basically the point is you're always reinvesting into a new bond for the same amount. And that way, over time, interest rates go up, interest rates go down. You couldn't care less because you are taking what the market gives you. And in this case, it's the bond market giving it to you, of whatever that return is. It's still going to beat the pants off of CDs, and it's still going to be better than having your money sitting in the bank. You can buy bonds and sell bonds at any point in time. So if my phone rings and somebody says, send me all of my money, I can sell the bonds and out-process their money back to the individual at any point in time. However, when you get into a bond ladder, I would rather sell equities most of the time to free up money than mess with a bond ladder, because a bond ladder is a very efficient machine. So when you think Harvard Endowment Fund, when you think the Chicago Police Force fund, or firefighters fund, that's what they're doing. They're buying these individual bonds like at $100,000 a piece, and they're laddering them. So they're making that money. Insurance companies do this. Banks do this, to be honest. They make 4% and they pay you 0.4% on your deposits. So that's a pretty good deal, right? So that it's really a very smart way to invest. It is not getting rich quick. It's boring. It's like watching paint dry or grass grow. There's no high fives. There's no bragging at cocktail parties about how good you are at picking bonds. You get none of that. You just simply make money over time, which for people like me, that's exciting in its own self. I like the low risk stuff mixed in with the higher risk stuff. So nice to have a little bit of both. So that's the basics of a bond ladder. Now there's also what's called the par price to a bond. So the face value of a bond is basically $1,000. So, and of course they have to make it difficult. So it's in relation to use 100 as par. Anything that's above 100, if a price is quoted above 100, then it's above par at a premium. If it's at say 97, then it's at a discount to par. So if you think the face value is 1,000, and you look to buy it, and it says, okay, well, the face value is 1,000, the price shows up at $100. So therefore, if you want that bond, it will cost you $1,000. If the price is quoted as $102, then you would have to pay $1,020 for that bond. So you simply put an extra zero, is my point. And then the last example of it at a discount, if the price quoted on the bond, say it's an Apple bond and it's trading at a discount, which would never happen because they all trade at premiums. But if it's showing up at $97, then you would pay $970 to get that $1,000 bond. So when you hear par price, that's what happens. Now, when a bond reaches maturity, because remember, when you buy an equity, you own a piece of the company. You own that till you sell it. You own it for the holding period's forever, especially if you're Warren Buffett or a long-term investor, which I think is the way to go. For the most part, you do have to make some moves, but when you have a bond, every day you hold a bond is one less day you're going to hold that bond because it has a maturity date, and it literally at the maturity date it goes away. You get your money back and last coupon payment, and it doesn't exist anymore. So you have to buy more. So the bond market's actually about 6 times bigger than the equity market. And most people don't know that, but that's because there's so many institutions out there holding these large positions of bonds. So that's what's going on when you hear a par price. When you think of what a bond ladder looks like, if you were to look in your portfolio, it's easy if you see, like, I own a share of Apple. It says AAPL, that's the ticker symbol. It does have a CUSIP, if you've heard of the term CUSIP, but you don't ever see it. You just see the ticker symbol. You see the quantity you own, you see the price, which they do the math for you when you log into your app or your website, and you see that, then it's your market value. And then generally you see position of your total portfolio. So in a case, if you were to have a bond in your portfolio, there's no ticker associated with it. So you actually do see the CUSIP, and it's 8 digits, which either can be, it's alphanumeric, so it can be a letter or a number. And then for Ford Motor Company, it simply says you have a CUSIP, which doesn't tell you what it is at all. It's just a code. And then you have to enter the name, where for stock, it would say Apple. Under the name, it says Ford Motor Company. And then it has the coupon payment. So it says Ford Motor Company, 7.5%. And then it has the maturity date of August 1st, 2026. And it tells you how many you have. It tells you the price. So 30,000, it tells you the price is $106.87. And I already told you, you multiply those together and you get $32,061. Okay. That you don't need to necessarily follow the math, but then you look at the next one. The next one down says Dillard's. The next one below that is Raymond James or Prospect Capital or Apollo Global Management or Goldman Sachs, Murphy Oil, Synchrony Financial. I'm obviously looking at a screen, excuse me, to rattle all those off, all the way down to General Electric, which when the stocks get hurt, meaning a stock sells off significantly like General Electric did last year, their bonds get really cheap, because there's a chance they could go out of business. So you just hop in and buy the bonds for like 80 cents on the dollar, because you know when that bond matures, in this case, General Electric matures on July 15th of 2023, you are getting your last coupon payment. And in this case, it's $15,000 worth. You're getting your $15,000 back. So that's how it looks like in your portfolio. Now, when you check your bond prices, the price you see, it's just like in stocks. The price isn't really what it's worth. It's just with the last two, and we jokingly say the last two idiots on the planet agreed to. Now, obviously in the equity market, they jump all over the place because there are millions of shares trading hands. With bonds, it's not always the case because you want to buy them and hold them to maturity. It's like when you take a mortgage out on your house. You take a mortgage out and you agree to the 30-year term, and then you pay it off over 30 years, but you always, there's no real excitement to any of that, right? So you don't see the Ford Motor Company bond kind of move. Like it could go days without anybody trading it. So therefore the price is not necessarily relevant to its value. It's just what the last two people agreed to pay. And people buy for one reason. That's because they want value out of something. People sell for all kinds of reasons. It could be that they don't want to own this anymore. They want to own something else, or they have a bill to pay, or they want to buy a house. I mean, so you don't always know what people are selling, but when people are buying, it's because they want their money to make money, right? So that's what they look like in your portfolio, and they don't move a whole lot. So the next topic I want to cover with you is when you think of a bond that, say it's a 3-year bond, and say that it pays $40, and bonds pay out every 6 months. So you buy the bond, and then it pays you, say, a $40 coupon payment in, say you buy it on January 1st, and on July 1st, you get $40 into your account because that's your coupon payment. It's kind of like a dividend for stocks, except dividends pay quarterly generally. Bonds pay twice a year. So on July 1st, $40 goes into your account. That's interest. So if you're a tax guru out there, yes, it's taxes interest. It's not tax advantage like dividends. You wait till January 1st, another 40 goes into your account, and that's the first year. Then the second year, July 1st, 40 bucks into your account, and back to January 1st, another 40 bucks. And then in the final year, you get on July 1st, another 40 bucks. And then when it goes back to January 1st, on that maturity date, you get your $40, and then you get whatever you paid for the bond back. So sometimes it's set up to where a bond can be callable, which if you think of the mortgage analogy, when sometimes you pay down your mortgage and then you get to that point where you just want to pay it off. Well, you can do that, right? In bonds, sometimes the companies have the option, and I like to use these because they have to pay more in coupon payments to have this option, is they're like, okay, here's the bond, here's the deal, here's the terms of it, the interest rate, the maturity, the payment dates, all of that, but we can buy this back at any point we want. And if they can do that, they have to pay you a premium along the way, and that's structured in. So if it's a 6-year bond and they say, okay, well, we can buy it back at year 2 at $103, which is above par. So you get a 3% premium on whatever you paid. And then if they buy it back at year 4, then it's maybe a 2% premium, right? So there's options that can be structured into a bond that looks like that. So let's take a more real bond out there that's a $10,000 bond, and it matures 6 years from now, and say you don't buy it at par. So it's listed, we'll say it's a General Electric bond like we were just talking about. The stock's down significantly, and it's a $10,000 bond, but you pay $8,500 for it. Okay, it's a $10,000 bond, you're paying $8,500 for it. You know in 6 years, you're going to get $10,000 back. So you know if you just hold this to maturity, you're making the difference. I'll call it 15%, even though it's a little less because of the math, or excuse me, it's a little more because of the math, but you're making the difference. You're making that $1,500 on the bond, and you're getting coupon payments of $400 twice a year, the whole time until the maturity date. Then you get your $10,400 back. So cash flow, you pay $8,500. You get 400, 400, 400, 400, 400, 400, 400, 400, and then 10,400 back. Now, imagine that cash flow layered over a bond ladder with 20 to 50 bonds in it, and there's constantly money moving into your portfolio from those payments that is now can be served right back into a bond ladder, and to make this a finely tuned bond machine. And I tell you, that bonds do not get enough credit. For people who don't like the ups and downs of the market, you just don't like it. I will tell you, of course, over time, you're going to make more money in the market, but it's a roller coaster. And I enjoy the ride because I look at it every day, pretty much all day. and I'm on top of things and I can make adjustments. Most people aren't like that. They throw their money in and see what they get kind of towards the end of it. But bonds they're not exciting. They're not sexy, if you will. They're literally boring ways to incrementally build wealth over time. So don't forget to have these in your portfolio. Okay. Last thing I will leave you as I close here today is your bonds can be in the red. So say you pay $10,000 for a bond and you look at it 3 months later, it's worth $9,000. So when you look at your gain loss, it's showing that you've lost $1,000. And that's true if you sell, that's true. You will have lost $1,000. However, some things can go into that. When you buy a bond, you'll pay a small commission. Remember, equities have gone basically commission-free. Bonds are not yet because it has to still involve a human, if you will, to make that trade. And when you buy a bond, if you buy a bond that matures every January 1st and July 1st, if you buy it in March, well, you owe the current bond owner, a third of the coupon payment for that 6-month period. That wasn't a perfect example mathematically, but if somebody who's held that bond for a couple months and you buy it from them, well, you pay them up front that interest. So when you get to the coupon payment, you get the entire coupon payment back. So if you were to set up a bond ladder today of $10,000, $100,000, or $1 million, you're immediately going to be in the red because you had to pay out the accrued interest. And if you see that on your statement, that's what that is. That's accrued interest, and it takes up to 6 months for that to get to work out. Now, will bonds stay in the red? Well, not if you hold them to maturity. It's like a limit function. If you remember your high school, I think it's calculus when you cover limit functions, and no, that's not the most exciting thing that probably happened in your high school years either. But if you remember it, it's kind of that, I'm 6 feet from the doorway, and if I keep moving halfway to the door, I will technically never get to the door. I'm going to get like really, 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 really close, but I can't get there because it's only half and it never gets there. So same sort of graph, if you will, with bonds as it approaches the maturity date, whether the bond is above par, below par, in the red, in the green, none of that matters. You know exactly what you're getting back at the maturity date. You get the face value of the bond and the last interest payment. The price in between is only what, again, the last 2 idiots on the planet have paid for that trade. So we talked about what can cause changes in bond price. Well, supply and demand, really. And if interest rates rise, then the price of bonds will generally fall. But remember, they mature. As your ladder hits maturity, each bond maturing goes back up to its par price. And that's what you might have seen now. If you're in bonds, now that interest rates are lower from whenever you bought them, you might be in the red on your bonds. Well, that takes some time to what I call heal, because it's, where it's going to be at maturity. So let's not sell it before then. Otherwise we've given up on it. So it naturally progresses towards par value. So when I talk to folks about bonds and they say, why are they down? I kind of say, it's tough to say, don't worry about price, but literally don't worry about price. What the value you're getting it. When you buy it, you're actually buying that cash flow example that I talked about. You're buying, basically 6 or 8 coupon payments, and you want your money back, at this time. So that's, you're signing a contract to get that. And so if you buy it, that's what you want. You don't want your money back early. You don't want to have to sell it. You don't care what it's worth in the meantime. I use an analogy of relating it to your house. If you buy a house when your kids are, say, in 4th grade, and you want them to graduate from high school at your local high school because it's amazing, because that's why you moved in the neighborhood. Well, guess what? Who cares what your house is worth during that 8 to 10 year period while you're living in it? For the reason it's serving its function. So you don't care. You do care, right? And you still check it. You might look on Zillow every now and then, but you really don't care. You're not going to make any moves based off of it because you're in that house for a reason. Now, once you exceed that reason, that's when now you take a look at whether you'd want to sell your house or not. So anyhow, it's not a perfect analogy. I know that, but at least it's a way to resonate with some folks. So that's all we have for today's episode. A lot of math. So I know that's tough on a podcast. There is a version of this available on YouTube channel called On Time on Target. So if you want to check it out there, you're like, Steve, you should have told me that up front, right? Well, I didn't. So sorry about that. but if you want to see the slides that go with it, you can kind of walk through some of the math there. So please reach out through ototnow.com with any questions or comments. Thanks again for listening in, and here's to you fighting the good fight every day to be on time, on target with your financial goals.